Hey everybody, thank you guys so much for coming on to this call. First off, it's May Day, so happy Aloha Friday. As we kick off this call, just want to say appreciate all of you guys for being here on this busy Friday. So this is week 2 of our 8-week series that we have here. And realistically, guys, the goal here, simple. We just want to give you guys insights on how deals get funded. We want to help structure deals so you get the highest ROI on your money. What's a good deal? And what actually makes a good deal worth doing. Yeah. So with all that being said, this call is here to help our community show the difference and bridge the gap to what you hear online, what other people are seeing, and how deals actually get funded. There's a lot of noise out there, but the deal still needs to make sense. The structure matters, and the money side is sometimes where people get it wrong. So we're going to be cutting through all of that, showing you how these deals actually works. And just to be clear here, we are not going to be selling anything. There's no courses, no monetary exchange, just value on this. All right. So first, we're going to be going over what's happening in private lending, what's actually going on right now as we see it, as things are moving forward. We're going to walk through private lending overview so you can understand what it takes to be borrower ready. So if you're working on a deal or planning to work on a deal in the future, pay attention. We are here to really help guide you and point you in the right direction. So without any further ado, I'm going to be calling on Kain. You're up first, brother, on this.
Yeah, I guess kind of all of us. If everyone wants to go through any kind of learning lessons that we found this week or that we learned this week. So the one that I had this week was comps, right? Specifically as is value or ARV rather. So the situation we had a ground up construction in Atlanta. The comps seemed pretty spot on. We've been working with this builder for a long time. She has 2 other projects within a mile of the same property that we're going to fund. One of her projects just sold for about 800,000. So she's expecting her ARV to come back for this one. That's literally like 0.9 miles away for 750 conservatively. Right down the street, like 2 days before the appraisal took place, another builder who might have been underwater on their project. I don't know why they sold it for so much less, but they sold for 550. And I was looking back at what they bought it for. There wasn't really much spread in the deal. So I'm assuming they just had to get out from under it. But that sell at 550 really affected our after repair value, our complete value for the project. So another good reminder just to stay conservative when you're running numbers, because anything can happen. You can have another investor or a seller who's distressed sell a property right before your appraisal goes out, and that can kind of mess up your whole terms, right, that you're getting based on what after repair value you thought you were going to have. So yeah, another good reminder just to be conservative when it comes to what comps you're using, or at least be ready to pivot, right, which we had to do. We had to lower the leverage a little bit just for the deal to make sense for everybody. So that's what I had. If anybody else has learning lessons, John, Keli'i, I don't know if you guys had stuff that came up this week that you guys want to share.
Yeah, I can share mine really quick. I think it's something that isn't put a lot of attention is not put onto it as other aspects of the deal, which is finding the right title company. Like it's really important to align with the right title company that really understands what private lenders require, especially with title endorsements and title insurance. Because if you're going to a title company that's only used to mainly doing conventional loans, they might not require the typical endorsements and insurance that we require. So that's super crucial because the wrong title company that's not used to doing our types of deals and handling our money could potentially delay or even kill your deal. I'm sure you guys have had some experiences with title companies specifically. Typically, it's the borrower's choice for the title company. But again, we have, especially for Hawaii, we have our set specific title partners who know exactly what we need. But we also have partners with national title companies that can help with that as well. So if you guys are buying on the mainland, come to us. If you need a recommended title company, it's much better than going on Google and trying to find a random one that has the best reviews. You never know, it might not be the best fit. So that's something really crucial to take into consideration as part of your deal package.
Yeah, no kidding. Title, I would say insurance too. The conventional space consumer side is way larger than ours, right? So you're going to find a lot more title, a lot more insurance we're used to covering homeowners, right, rather than investors. That's another just kind of double check you should have, is if they're used to working with fix and flips, with new construction, or if they've really only done title or insurance for homeowners. That's a big thing to check on.
Yeah, and you guys can also lean on us as well, because we can tell pretty much instantly if this title company is used to closing our deals. They'll ask a lot of questions that are typically common for conventional side of loans, and we'll know, okay, this company's probably not used to closing our type of deals. So just lean on us as well and ask us for advice.
Keli'i, did you have anything from this week?
Yeah, so if we're talking about learning lessons, yeah, I mean, a couple of things just come to mind for me. I won't go over it too much here, but I think the whole segment, guys, that we can talk about how to get draws for your guys' rehabs.
Well, I think you
When,
need to talk about, at least at a high level.
okay,
So
yeah,
sometimes the draws, right? Like we're
yeah,
talking about construction draws. So if you have a bridge loan and it comes with a construction holdback, then a lot of times nowadays with single family, they'll do 100%, right? But yeah, you also want to know, is that paid in arrears? And sometimes it's not 100%. Like Kelly, if you want to share.
yeah, yeah, I'll definitely go through it. So, guys, when you guys are pulling for your draws, like Corey mentioned, most times, if there's enough room in the deal, you'll get 100% of the draw. So what that means is it's a reimbursement on the draws as well. When the work is done, right, you submit to the lender that, yes, work is done. An inspector comes in and approves the work to verify that the work has been done. Once that's approved, you guys are actually going to get reimbursed the money from the draws. Now, most times when we do deals, you'll get 100% reimbursement. On this particular deal, it wasn't 100%. It was about 75%, right? So if you get a draw for $100,000 and you only get a 75% reimbursement on that, that means of the $100,000, you only get $75,000 back. And the $25,000 is what you'll be responsible for. There may be some questions as to, why was it funded that way? And the reason why this particular deal was funded that way is they would have had to come up with more money at close up front to make sure that the deal stays in line. Rather, if they didn't have to come up front, it would have to be paid in the back end with the draws being reimbursed.
This is a whole topic on itself, is leverage allocation. How do you allocate the leverage, right? because on paper, one lender is selling 75% max LTARV, right? Loan to after repair value. They'll only go up to 75%. And the other lender's selling the same thing, 75%, but it could be totally different products, right? Like our product where we wrap interest, so we max the 75% all the time, whereas some don't, because maybe they don't go as high up on the LTP, loan to purchase, right? So they're not really maxing out, and they don't wrap interest payments, so it's coming out different, the leverage, right? So we can talk about that on that's a whole nother like segment we can talk about. But I think it's a good learning lesson about like always check your terms, right? Sometimes the loan process, it's long, right? And if you have multiple deals going on, there's so much crossfires happening during escrow, and so things slip and you can forget. But if you do a double check, because sometimes it's not 100% on your budget, because you have to allocate the leverage in order to close the deal, right?
Just to double back on the types of draws, there are pro rata, which is like Keli'i was explaining. So there's say you have $100,000 draw and you're only at 75%, they would pay out the 75,000. But then there's also a different type of draw structure where it's kind of like a medical deductible, where they'll pay up to the 75,000 and then you cover that 25,000 in the front. So there's a couple different ways that draws could look, but ideally we always want to try and get you the 100% rehab as much as possible, as long as it fits within the deal.
Yeah. The other thing I was going to mention is talking about terms and making sure you're understanding the terms that you're getting. And this is probably a whole separate video, but even as simple as it seems, but like loan to cost, everyone says LTC for loan to cost, but it doesn't mean the same for every lender. Every lender calculates LTC differently. Some people say it's the purchase and the rehab, and that's the total cost, where there's other lenders that'll say they'll add in title, taxes, interest payments, which makes then your cost a lot higher, which can make your LTC much higher. So we get it all the time. Like we talk to investors every day who have competing term sheets, right? and they're getting 93% LTC, but for some reason their leverage is still less, so don't get sold on a high level terms, like really understand the terms that you're getting and what makes the most sense for what kind of investment strategy you're doing, right? How much capital you have allocated towards this project, how much you have allocated towards the front versus maybe you're getting a capital injection later down the road halfway through the project where it makes more sense to do a pro rata draw versus an upfront. So all those things, that's why it's important to talk to us or talk to your partners, talk to anyone that you're working with on the deal to make sure that you're structured properly from the beginning so you don't have surprises going down the road.
Just making sure that communication with your LO, how you plan on bringing in your capital, that's going to be really important, even on the front end, like where your down payment's coming from. If, like he mentioned, say you're selling a project halfway through this one and you'll have a capital injection. All of that is going to be really important to make sure they're structuring your deal so that it reduces the amount of cost and time for you as you move through the project.
Yeah, speaking of, I mean, just being transparent, right? The more transparent you can be with whoever's structuring your loan, the easier it's going to be and less surprises you'll have throughout the entire process. Another big reason to be transparent is like we've seen in the private lending space, there was a huge scandal that happened, right, with false appraisals and false titles and recordings and stuff that happened somewhere in the East Coast, one in Baltimore, one in Philadelphia. But anyway, it wasn't that small. It was like a few $100 million, I think. That affects the entire private lending space, right? So you can have a few bad actors kind of ruin it for everybody else. And then when you have that, that comes with higher rates, stricter guidelines, less money available for people to be in our space. And then with stricter guidelines comes now, maybe the capital dries up and they say, oh, you've only done one or you've only done five, like we're only going to lend to experienced guys. And not to say that, I mean, obviously these people are not being transparent anyway, but even if you're not being transparent and it comes across as some sort of fraud, or it looks like you're trying to pull one over on underwriters, then that's going to affect the whole space also. Because even if it's something small, but if everyone starts doing it, it's going to affect the entire ecosystem that we're trying to protect here. And also if you are doing, it may seem like a small idea to you, but if something big happens, right, like this Philadelphia thing, and now all underwriters across the board are being extra strict, keeping a closer eye on everything, it's just going to make it easier for them to say no to a deal because you're not in the know of what's happening in the private space, that you think something might be a small deal when really it's following from another big event that happened. So transparency is key with everyone. We'll try to be as transparent as we can with you guys of what's going on and everything. But I know a lot of times to investors, they're just trying to get the deal done. They have 15 other projects that they're working on. So they try to just give the high level info, and we'll do our best to ask if there's anything else, right, that we're missing. But I get it. Like when you're doing volume and you have a bunch of projects, we're doing a bunch of projects, things can get overlooked. But I think if everyone can just do their best to work with your team as much as possible, right? Your LO, your partners on your deal, your GCs, to make sure everyone's on the same page, it'll just be much smoother for everyone.
Yeah, and like we were talking about last call, is like time kills all deals is what we learned. Because like you have to remember some of these institutions and some of these companies, like they're doing thousands, like there's so much money being tossed around and like traded hands. So you want to remember that and not take it for granted, because when they'll look at files, how long have we had this file? What's their credit? What's their track? Move on, and so you don't want to get to that point, and it does happen. They get tired of a deal, tired of loans, or a certain even borrower sometimes. So we shouldn't take it for granted. It's not like they have to lend to us, we always got to remember that.
Mm-hmm.
So there's so much more, but is there any
Tadeva
questions
was
about
asking
these topics?
she's asking if we do long-term rental loans. Yes, we do. Short answer. DSCR loans. I mean, that's really the only, debt service coverage ratio loans. Is there another long-term? We don't do owner occupied right now, if that's what you're asking, but any kind of investor related non-owner occupied, yeah, we do. So DSCR is very dependent on two things. One is your credit, and then two is your DSCR ratio, right? So Your ratio is just what your monthly income is. Does it break even with your principal, interest, taxes, and insurance, right? So if it's 1:1, then that's a 1 ratio DSCR. If you're cash flowing more, then it's up to like a 1.2, 1.3, whatever. And then we can go down to a negative cash flow, which there's reasons why you would do that, right? Like if you know that you're gonna maybe collect more rent than what the market, than your appraisal gives. Like maybe your appraisal is saying that, it's only gonna be worth, you're gonna make 3,000 a month, but you know for a fact that everyone around you is making 5,000 a month. So at that point, we can go down, our guidelines allow up to or down to 0.75 DSCR ratio. But on average,
And
it's 1.
and do you guys require a seasoning period?
Yes and no. So it depends. For a purchase, no, you don't. If you're refinancing like a fix and flip, it's 90 days.
Okay.
If it's a short-term rental, typically, yeah, I think more now we're seeing more capital partners wanting at least 6 months up to 12 months of seasoning.
To add too, I just did one last night, and here in Hawaii, they had their house for a while, but there's the interest rate came into 6.3, and that was with a 5-year prepayment penalty. He wanted to do one with less penalty, so we did a 3-year, and that one came out to 6.7. So rates are pretty good.
What's the LTV on that?
That one came in at 80%.
Oh, wow. So it's lower than what
Yeah.
it just was recently. Because I
Yeah.
was looking probably like a week and a half ago, and it was around there.
And I think that's the things, guys, like things change. Like DSCR rates, I think they change like almost daily.
Yeah, we get a update almost daily, I think. It does change pretty quick.
I think we can keep moving forward. We talked about a little bit of the credit stuff. John, did you want to talk about some current events too as well, brother, going on here?
Yeah, the point that I want to touch on that I'm sure a lot of the investors are feeling as well, the rising material costs tied directly to the global conflict and rising fuel costs. I was just checking the National Association of Home Builders. Lumber is up 5.6% from last year. It's trending upwards. I have a borrower right now doing a lot of ground up builds where the LA fires happened, and he's wanting to get his lumber orders in right now ASAP because he's expecting them to go up at least a couple $1,000s here in the next couple months. So all that little stuff adds up, right? And it ties directly in. So that's why we want to have this segment to keep you guys posted. But if you guys notice anything else in the market, feel free to share as well. And then the credit stuff, I'll pass it over to Kain. He'll dive more into
Yeah,
that.
the credit thing was kind of more so along Philadelphia and Baltimore.
Sure.
One thing that we're actually seeing with the rise of costs, and maybe if anyone wants to chime in, if you guys have noticed anything on your side, but we do notice that underwriting across all of our capital partners are asking for a higher contingency, right? So before we used to be at 5%, sometimes they wouldn't ask for one at all. But now just with the rising cost, and this is, keep in mind, our guidelines kind of go nationwide. So some markets will be affected more than others, but it went up to 5%. And then I swear like overnight, it went up to 10%. So just plan for that. This effect, that Atlanta deal I was talking about earlier, is that we had to have we just have to fit in more contingency just because of what the capital feels comfortable with rising costs, which is another reason why you guys should be conservative, right? When you run your numbers initially for deals, it's like, you never know when a capital partner might just say you need 10% more contingency in your rehab budget when you were already super skinny on the deal. So like contingencies being added, prices going up, another investor or a seller selling their house for way under, right across the street from you, right before the appraisal goes out. All just good reminders to be conservative with your numbers and remember what your job is as an investor, right? Is ROI. And if your job is ROI, then you should be conservative and try to raise that as much as possible throughout every step of the process. A lot of people fall into a debt trap because they try to get more deals and more deals by getting tighter and tighter deals, right? They try to beat out the wholesaler or the other investor by going a little bit more on the purchase price or a little bit less on their rehab budget, and it ends up biting someone in the end because, as we've seen, whoever's been in longer than a year, basically, you can see the market go up and down, and even like a 5%, 10% correction in the market will eat up your whole profit if you're running deals super tight. We see it here in Vegas. Guys run deals super tight out here just because they're doing a volume play. They're trying to flip 10 a month. And the only way you can really do that with how many flippers are out here is what they think, right, is by getting tighter deals, getting cheaper cost, but like barely, to the point where it ends up not being a deal for the most part. People's ROI is significantly less here than it is in markets like Hawaii or Los Angeles or Miami, right, where the price point is higher. But basically be conservative with your numbers, run your numbers correctly, and really try to hit your ROIs and profits that you as an investor have a risk tolerance for, and don't change on it, right? Be disciplined with your numbers. I think the main part of this call, we're going to go through the process. Someone asked last time what our private lending process is.
Yeah.
So we can dive into that.
Yeah. So just to give you guys a quick high level overview of our process here, loan request, that's when you guys submit the deal with us. We're pricing it out, full file, property valuation, full appraisal. We also have options for BPOs, broker priced opinions, depending on the project. Because of our relationships in the MPLA and different capital partners, we're very flexible, and we figure out which box your deal is going to fit the best. And then after that's done, after the appraisal comes back, it's submitted to underwriting. Then underwriting will typically give us the first set of conditions. We take care of those conditions, and then the loan is officially funded and closed. And to dive deeper into this too, there's several factors, crucial factors that really affect the timeline of this whole process. Number one is organized docs from borrowers. So the more organized your guys' docs are, and if you can get us those docs in the timeline and the time frame that we need it, the higher chance we have of hitting the closing date that you guys have on the contract. So it's a partnership, right? We touched on it last call, see us as partners. We're trying to get the deal done for you too. We're playing both sides, right? But we have to make sure everything fits underwriting's guidelines, all the docs are in line, as well as get you the terms that we're pushing for with you guys as well, and making sure that you guys are getting good deals, making sure you're getting us good deals to get good return ROIs. That way you're doing more deals, and then the business just keeps on going. And there's several things. So to start off on the package submission, or between the loan request and package submission, there's several main docs that we need to kick the deal off, which are the loan app. We have a track record template, scope of work. Really, those three main things. Those three things are mainly needed so that we can order the appraisal. And typically, it's the appraisal that takes the longest. If we rush the appraisal, we can get that back within a week or less, depending on where the property is and what type it is. If you don't rush it, then it's going to be a little longer than that. But again, depending on your timeline, all we ask is for transparency. We'll work with you guys to find the best structure and figure out what the estimated timeline will look like based on our experience and the type of deal. So it's really
One thing I'll mention, John, like this is not just our process. This is the private lending process kind of across the board. Every lender goes through the same exact thing, right? You guys, whether it's an email, a phone call, a text message for an unofficial loan request, right? You're getting, say it's a fix and flip, right? You're telling your LO what the purchase is, the address, the rehab budget, and your ARV, and you start there. And then probably also like what your credit score is currently, which we know that can change pretty quickly, and then your track record. Every lender is going to ask for that, right? Because that's what we're structuring the deal off of. As a lender, we're looking at the collateral, so the deal itself. We're looking at the deal driver, who's going to execute it, which is you guys, and we look at track record and credit to determine that. And then we look at the entity itself, like your LLC, making sure that your paperwork's in order to take on the loan under the LLC or under your S corp or trust, whatever you're holding your property in, because we and the private lending space is business purpose, right? So we're lending to businesses, not to an individual. So this process is true for everyone. Any capital partner that you guys use or any lender, this is the high level overview of the same thing everyone goes through. And this could take anywhere from 2 days to 30 days, right? Depending on how fast you can get docs in and the correct docs, right? Because it all goes into underwriting. You have the full file. So you do the loan request, you have the full package, right? Which is all your entity docs, the high level details of the deal. Once that appraisal comes in, then you can submit the full file into underwriting. And it's everyone's job, from the LO to the processor to you guys or to the investor, to try to build that file as cleanly as possible so that when it goes to underwriting, there's no conditions, which rarely happens. I mean, you see it every once in a while, especially if you're working with the same borrower, the same LLC for multiple deals, then it gets a lot easier. But if it's like your first time, you don't really understand like the structure that an underwriter is looking for, those things cannot drag on. But I think the biggest thing that we see is not so much the entity, it's the valuations lately. I
Yeah.
think that's true kind of across the board with all capital partners, because we had a huge talk about it at the MPLA, right? Which is valuations and making sure we're having the correct values and all of that.
So, those are good points. So to add to that, we put trust in our borrowers that you guys are running numbers conservatively and the ARVs are as accurate as possible. Because like Kane mentioned, lately we've been seeing a lot of valuations come lower than expected, which adds time to the timeline of the deal. So we do take additional time as well before we even get pricing. We ask our borrowers, hey, do you have any comps on hand that you can provide to us that support this ARV? Just so we can avoid that potential wrench in the timeline if valuations come back lower than expected. So we like to be conservative. We would like for you guys to run numbers conservatively as well. It's in everyone's benefit to do that.
Just bringing question to the panel. She's wondering what the difference is for brand new investors and how do they qualify with no track record?
You can still qualify. So we lend to everyone on with track or without. Like you'll have better terms with a track record. Obviously, you'll get a higher LTV. Well, actually, lately now I feel like we see 90% kind of across the board for everybody. But without the track, the biggest thing is going to be the collateral, right? So the deal itself. Are you conservative with your numbers? Are you getting at a good deal? Are you going to make a profit at the end? Because if it's super tight, every capital partner is going to pass on it, unless they're like a loan to own type of lender where, not to say that they're like preying on your downfall, but they know they're safe because they're going to take the property back. We are not in that business. It takes way too long to try to take properties back. So we'd rather just everyone do good deals. And we're trying to securitize these notes anyway. We don't want to end up in a buyback situation where we originated a bad deal, let alone 20 of them, and now we have a $10 million buyback.
I'll just add on that too. I just got a question from a first-time investor, and got them the terms, got them 90% on the fix and flip here in the islands. And one of the questions that he brought to me was, do I need to use a general contractor, right? And to be upfront, not necessarily, but I know a lot of people don't like to use them because they save money, right? But if this is your first flip, right? Like you guys want to use a general contractor because they know what's going on. They know what's going to be done right. Yeah. I get that question a lot, actually, believe it or not, even with some guys that, have been doing this a little bit, but I would just encourage you, definitely use them. They know what's going on and you got somebody by your side to ensure that things are going to be done right.
Yeah. And basically every capital partner nationwide is kind of starting to require it anyway. One thing about the MPLA and the private lending space getting a little bit more seasoned is a lot more data is coming into the space, right? And so like two big things that they realize: one, borrowers with below a 700 credit score have a significantly higher default rate or late payments. Another one is projects happening without GCs have also a much higher default rate because properties are not selling, right? Or they're not being completed. So the good and bad, right, about data: one, more money comes into the space. The bad, which is not really bad, maybe it's unfortunate for some people in their investing strategy, but it comes with stricter guidelines, right? And making sure that the projects become successful. Nobody makes money. You guys especially don't make money, or anyone who's an investor, if the property doesn't sell, and if it doesn't sell, it doesn't get paid back. And then the whole private lending space, the fix and flip space, new construction, it all kind of just starts spiraling down. So it's not in anyone's best interest to save, a few $1,000s to get something done a little bit cheaper when the data shows that if you spend that money and you do it right, there's a much higher chance of it getting paid back and exited successfully. John, did you finish up the process stuff? I know we kind of went on a tangent a little bit.
Yeah, that was pretty much it. A quick overview of that process. Yeah, like Kane said, that overview of the process is applicable to all nationwide lenders and capital partners.
And even if you guys think you see something different, it's not different. This is how it's done in the lending space across the board. Like some things might be like fused together or done quicker, but I mean, at a high level, like this is what it is. We're pretty close with like the top 50 lenders nationwide. We pretty much know what everyone's process is inside and out. And so unless you're going to like a small family office or you're getting OPM basically, or if you're just going to like a person who's going to fund the whole thing, then yeah, it might be a little bit different. But if you're getting institutional capital, this is the outline they're going to follow. And so with that, I mean, you could dive into every single one of these sections too, and there's a
We
whole
probably
list
should.
of things, right?
Well, we probably should in the coming weeks.
Yeah. Yeah, we'll dive deeper.
Because that's where you get lost in it, is all the little stuff like are you in a rural area? Because if you're rural, like most likely most capital is not going to fund you. You
Yeah.
gotta go to specific type, which there are, but
I mean, there's places on the Big Island, right? Big Island, even Maui, where it's technically rural, right? Even though it's pretty close distance-wise, but because it's ag land or whatever, a lot of those things are going to be case by case. If it's actually rural and it's like a population 2,000 and your nearest town is 2 hours away, then yeah, no one's really going to touch that. At
Yeah.
that point, you have to find like a family office or you have to get OPM and raise capital for a specific deal.
So these are the things that experience really teaches you, right? So overall, this whole process is pretty simple. But like Corey said, it's the little nuances and the little details and the little things in the guidelines that the LO should know. And that's why you guys have us as a resource to lean on and ask questions for.
Yeah. Oh, so even actually just looking at this, right? So I was just pricing out a deal in Florida, but loan request was good. We submitted the full package, but when it came to valuation, so there was significantly more fire damage than the borrower disclosed. Actually, the borrower didn't disclose any fire damage to me at all. I mean, he said it was cosmetic flip, super easy in and out. It was like the as is was like a $1.5 million property. His ARV was close to 2 mil and he was putting in like 90K into the property, which I already had my, flags were already going up because if you're in that price point, unless you're like in a very high dollar area and the house it's pretty new, then maybe you can get away putting 90,000 into a property. But of course, it comes back. Actually, underwriting already saw the deal. A broker sent it in a while ago. And so they already saw it, which of course this bar doesn't disclose it to me. But there was a significant amount of fire damage, which the scope of work was not going to cover. So again, with just being transparent with everyone that you're working with, not trying to slide things in, because we spent like a week on that file, putting stuff together, collecting docs just for, like, I could have killed it in the beginning and it would have saved him time. It would have saved me, the processors, underwriting, everybody time. But now, especially because he did that this time around, underwriting already flagged his name as somebody who's like going to try to sneak things in, So now every single file that he submits is going to get extra scrutinized. And even if it's a great deal, they may just pass on it because now they understand, they know what his character is, So that's one thing you should remember is that the private lending space, for as big as it is very small because we all talk to each other. We have face-to-face conversations with the underwriters, the LOs. We meet up at these conferences every, a couple times a year. So we're pretty close and have personal relationships with all these guys. And no one wants to see the industry go down for the sake of winning one deal, right? And so everyone's going to talk. All the underwriters talk, all the LOs talk, all the capital partners. Yeah, we try to compete and we're trying to compete against each other. But at the end of the day, everyone wants to stay in business and they want the business to grow, And so just keep that in mind. If you ever think that like you're going to try to slide one past, because underwriters are trained to be skeptical from the beginning. I used to hate it, but I understand it now, like the longer I've been in this, because it makes me be more skeptical and it saves everybody a lot more time.
Yeah. So just to add to Kane's point, we're playing both sides, meaning we need to figure out what underwriting needs and go along their box and guidelines. And we're also trying to make your deal work as well. So that's what we ask for you guys to be transparent. We're not here to try and kill every deal. We want to make your deal work, but it's also going to fit what the underwriters are looking for.
Yeah.
This is good. This is good stuff that it's not shared out there. And then you find out mid closing, like, oh, and we could have figured out stuff way ahead. And sometimes you don't know. Sometimes it's a new one. It's a new curveball. Or sometimes it's the same curveball, but this was like last year and we forgot to check that box, because sometimes it's like we're trying our best, as an industry, as a company to tighten our side up. We've gotten a lot better, and like where there's boxes to check in proper order, but even with that, sometimes it's hard because it's circumstance, right? A deal needs to close fast and we need to move fast. Maybe something that we would have normally had to have upfront first. Maybe we're okay with, okay, just get everything in piecemeal, whatever we can right now, which is not normally how we do it. I think that's industry wide. Is like now you're not only working with your company and your company's compromises, but also, your partners and their, how they compromise on their process. So is anything ever standardized? I think it can be. I mean, the consumer space gotten pretty rubber stamp, type, which is bad too. Like if it's so rubber stamp, like sometimes you lose out on opportunity to help more people, to put more loans out. So it's a balance that we're all trying to make. I think the lesson here, I guess they're tangible lessons, but it doesn't matter until it matters. You know what I mean? Like until you're in the situation and you have to close. And so a lot of this stuff doesn't matter until you're in a closing. But is anybody in a closing right now? Any escrows going on?
Well,
Hope
me, John,
so.
and Keli'i just closed all ours out for the week yesterday. Thank goodness. I hate trying to do it on a Friday.
Oh yeah. I guess just kind of for me, anyways, I gotta say, like this week it was a great week. Keli'i, John, and Kain like are just crushing it right now. They're doing great, amazing. Like all three had closings yesterday, and like more coming, and so definitely getting momentum. And like it didn't come easy. It was like a couple years of learning all this stuff, going down this path, and getting slapped around, and having to get back up. Sometimes apologize for things that we shouldn't be apologizing for, but we show empathy. We understand, what it's like to be on the investor side. We understand that, after we close, like let's say we're closing a deal together. After we close a deal, right? You guys have to get, like as an investor, you have to get your scope of work in order. You got to get your crew, you got to get bids, you got to get accounts set up, entity docs set up. There's so much to do just to get to closing, right? And then you got to get your money right, and then fill out all those applications and get your credit pulled and get the appraisal. And hopefully, if all of that works out, we close, right? And then so our team, we know that when we close, we might be done with that loan, but that's just the beginning for you guys, because we sit on the same side too. So there's also like consideration there where we're not just there to close. We understand that it's a lot of work and there's balls flying everywhere. That's why you need somebody who understands that and can help, So hopefully that's what people start to realize when they come to us, is that, we're not just order takers like we discussed on the last call. Keli'i, John, and Kain, they're structuring deals, they're solving problems, they're moving to different boxes and guidelines and understanding who's behind those. They have putting the work in, traveling the nation to build the relationships to have these options for all of us, right? So it sounds weird to thank you guys on our call, but thank you guys. And thank everybody too for showing up. I hope this room grows because again, we're growing a community, right? So I don't want to be the one to end this, so I want to throw it back to you guys.
Yeah, I mean, if you guys have any questions, any way that you can get more value out of this, whether it's a topic you want us to cover, or if it's a question you have right now that you've been, waiting all week to try to figure out and you want a lender's insight, we're here. We put this together to be a resource for you guys.
Also, if you guys are not already following us on Instagram, LaKea is doing a great job of keeping everyone updated on the stories. We'll put up polls as well on future topics that you guys want to see. So engage with us there. Just to follow and message us if you have any questions.
Yeah, and I'll just chime in, John. I was gonna just say the same thing, but if you guys have questions, you guys can reach us right there on Instagram too as well. La'akea is on there 100%. So if you guys have a question, drop it in. Happy to help out, and keep crushing it, guys. Have a great weekend.
Happy Aloha Friday.
Happy
Aloha.
May Day.
You guys,
Everyone, what a great call.
Thank you guys.
take care.